nevertheless, that's what those graphs illustrate. The time premium that's forfeited, the taxes that are paid, and what you try to do is avoid that, keep that to a minimum. You want to hold them to the end. You want to do like Steve Jobs did. He exercised a bunch of options that he had at a price of 5 when the stock was 95 or something like that. So he held them for the stock to go from 5 to 95. He exercised them on the last day. In other words, he held it for 9 years and 364 days. If you look at Larry Ellison from Oracle, if you look at John Chambers and James Dimon and other big-time executives, they're managing those things right. I don't know everything they're doing. I don't know whether they're hedging, but they're holding them to the end. And that's what I say. Try to hold them as long as you can, unless you just need the money.
Yeah.
Okay.
Yeah, well, there are other reasons why, and people have their own personal goals and
that's right,
and what have you. So, but it's important to at least be aware that this strategy is here. That there is a way to capture, if you will, some of that time value, basically by selling some of it off as you go over time.
Exactly.
Okay. So, why do you think advisors seldom advise hedging of employee stock options?
Well, it's a little bit more complicated than just making an early exercise, and selling the stock and then buy some mutual funds or buy an index fund or ETF. It's a little bit more complicated, and you have to know about options to do it. But they're supposed to be experts, and they put themselves out as experts, but they're really not.
Well, yeah, well,
okay, but the reason they're doing it is the companies don't want people to hedge. Because when you hedge, you're maximally managing those options. And you're delaying taxes, and you're not forfeiting that time premium back to the company. And that really raises the cost to the company. In other words, if you manage these grants to the maximum for yourself and reduce risk, you're going to end up, on average, getting a lot more than if you make the premature exercise, sell, and diversify. But the premature exercise, sell, and diversify benefits the company, okay? Because for two reasons. That extra time premium, or that remaining time premium, is forfeited back to the company, and they have a reduced liability when you do that. And there's also cash flows that come to the company as a result of early exercises. Okay?
So you get the option price that gets paid to the company.
Right, the exercise price, if you have the right to buy the stock at 20, and you exercise 10,000 shares, you buy that from the company. And so it's like a new issue of stock at a reasonably high price. Okay, they don't have to have another underwriting, and when they do an underwriting, the stock, when they announce an underwriting, the stock generally drops because they know they're going to have to find buyers at a lower price. So they're collecting sales of stock, although it's below the market because your exercise price is going to be below the market.
Right.
But they get cash flows. And in addition, the difference between the exercise price and the market value when you make this exercise becomes a tax deduction to the company, and they get credits for that.
Okay, so they get a tax deduction, and so they're getting a tax benefit.
Right, right. And so there's two flows that come, one from the employee purchasing the shares from the company, and if they sell them, they're not selling them back to the company, they're selling them in the marketplace.
Right.
You see? And so the company gets that flow, even at a lower price, and they get a tax deduction for the difference. And now there's some bills that have been proposed just recently in Congress, sponsored by Senator Levin of Michigan, I believe, where he's trying to alter that tax advantage of the employee stock options. Now, I don't know whether he'll be successful or not, but
So far they haven't. This has been an area of controversy for quite a while, and one of the reasons why is because in the past 15 years, I guess, there's been a development of financial reporting where they're requiring now a value to be assigned to these options when they're granted.
that's right.
And so what these congressmen are proposing is to limit the tax benefit that the company gets to that amount that you report on the financial statements.
No,
So,
Michael, when they report a an amount, they put a value on those options when
Yes.
they're granted,
Yes.
and they have to report that and use that as an expense against earnings.
Yes.
But the tax deduction comes when they exercise it.
Well, but
And-
but what I'm saying is that these senators are saying that you should be limited to the benefit you get or the deduction expense that you're getting on the financial
Yeah,
statement.
I'm sure they're saying a lot
Yeah,
of things.
yeah.
But it's turned out that the actual tax deductions that they've taken over the years is far greater than the amounts that they report as an expense against earnings.
Yeah, well,
And
for
I
some
think-
companies in particular, like an Apple computer, but there's others that haven't done so well. So,
Yeah.
okay, well, anyway, so you've talked a little bit about how you do it. So you're getting these offsetting options,
Okay.
and so maybe you can just
All right.
describe that a little bit.
All right, if you can go to your broker, Schwab, Options Express, Merrill,
Mhm.
or maybe you're a substantial executive and you're dealing with Morgan Stanley or JP Morgan Chase. Okay, and you just give an order, or they assist you with giving orders to sell calls against this portfolio of concentrated positions that you have, which perhaps consists mostly of employee stock options, or nowadays they have a new invention called SARs, stock appreciation rights,
Mhm.
which is a little different from the employee stock options, but it's really the alignment's about the same. And then, so you have all of these people that with these concentrated positions. If you sell calls, you reduce the actual effective market equivalent stock position by selling calls. Now, you might have the equivalent stock position of all your positions equal to 20,000 shares of stock. Okay, and you might say, well, all right, I'm going to try this hedging strategy and I'm going to go sell some calls which will reduce that 20,000 to maybe 15,000. And then you say, well, okay, I understand it now because I sold the calls. I did it in a margin account, okay? And the stock either went up or stayed the same or went down. Can't do any more than those. And you essentially have bought some protection against the downside. It's like a little insurance. On the other hand, you might buy some puts in addition to those sales of calls, or just buy them straight out. And the put buys are more profitable if you get an extreme move on the downside, because when you sell the calls, you're limited to making just what you sold them for. Now, there's an interesting strategy that you could actually, some people say, well, do I have to put up margin to do this? And a lot of times, well, most of the time you do, okay? Although you could put stock, if you have stock that's unrestricted, you could advance that into the account. Or you could put mutual funds that you have some, or you have to put some cash. But you don't get good collateral from putting the employee stock options in the account, okay? But sometimes people are looking for some cash in order to buy puts. And they might say, well, gee, I have some extra cash in my IRA. Okay, so if you buy some puts in an IRA, any gains you make are going to be tax deferred or tax free. And there's a chance that you could have good treatment to where you can actually deduct the amount that you, if you lose on those puts. But nevertheless, it's an interesting situation because any gains you make by buying a put in an IRA is after-tax dollars or tax deferred, which are superior to gains that you make by hedging if you have to pay ordinary income currently. And so the actual tax, after-tax results of buying a put in an IRA requires less dollars per after-tax gain or hedging strategies. Okay, so there's a lot of things you can do. Okay.
So John, I'm going to just slow down just a moment, and,
Okay.
and actually time is going. But with the numbers, the terminology we're throwing out, a lot of people are probably going to be confused. So a call, folks, is an option to purchase.
It's an exchange-traded
Okay.
option that gives the buyer
the right to purchase
the stock at a
Right.
specific price.
And-
It has
and-
similarities with the employee stock option.
Right. And so what's happened is that this is not a high risk. A lot of people think options, oh my gosh, this is high risk. Well, because it's covered with this other position, then it's not really a high risk type of a transaction. It means that you can satisfy when the person makes the call, you just exercise yours, and then you can provide the securities, and then everything is okay.
Yeah, by selling these calls or buying the puts that I'm suggesting, you don't want to do it unless you have these concentrated positions in your
Right.
equity compensation,
Okay.
and it results in a reduction
Again,
of risk.
so we've got to slow down for just a moment because we're running out of time. The put is an option for you. When you buy a put, then you've bought the right to sell your shares at a fixed price.
Right.
And so again, a put is more like an insurance policy itself.
Against an extreme move.
Yeah, against
Yeah.
an extreme move. So anyway, so these types of options are ways that you can basically provide offsets and to capture the time value using the calls,
Right.
or to insure against a fall in the value using the puts.
Right.
The puts, you have to be a little careful because they can do things like suspend the holding period for stock in some cases if you haven't met the holding period.
Yeah, if you buy the substantial in the money puts and stuff like that. Yeah, you have to be careful. And and if you're an executive, you have to be cognizant of SEC rules.
Yes.
And taxes come into play too. You don't want to incur tax liability sooner than you would otherwise do.
Right, right. So anyway, folks, I know we did this intentionally. It can make your head spin. On the other hand, it's good to know that there are these strategies that are available. The purpose of this discussion is to help people to develop defensive strategies and to try to maximize the value that they get from their options over the time that they hold them. And so that's why we're sharing this information. Again, it's intended to be an introduction, and hopefully you'll have a continuing conversation on this with your broker or investment advisors. John, maybe you have a final thought that you'd like to throw out, and then we have to wrap this thing up. Keep it short. We just got about a minute left.
Well, you want, I mean, how much can you save by using this strategy relative to what you would get by taking the traditional road of making the premature exercises, selling the stock, and diversifying? Well, my view is that you could save between 50 and 100% net after taxes. Okay. Now I saw the CFO of Qualcomm make exercise early where he forfeited $4.5 million as to I don't know where he got that advice, but he exercised real early, and the stock was not that much in the money, and he did it under what they call a 10b5-1 plan. And I said, gee, who gave that guy advice?
Okay.
He got like 25% of what he should have gotten.
Okay, John, we're all out of time. Thank you for being my
Michael,
guest. Thank you for coming here from Louisiana.
We did talk fast.
Yes.
And, I wanted to try to get into a lot this time.
Okay.
Okay.
Anyway, so folks, hope you found this of interest and you'll seek more information. We'll see you next time on Financial Insider Weekly.